Here we are in October of 2024. The stock market is up almost 20%, and that recession that everybody was talking about never actually came. So how were the experts so wrong to this point in time? Could we be running into a recession in 2025? And what are the real lessons that we can learn here that we can apply moving forward? Because there were some ingredients that people absolutely missed that we caught on to very early. If you remember, we actually talked about it here on the channel. So let's go ahead and break it down. So to talk about this topic is to talk about history, recent history, because we all went through this. So first, let's just talk about recessions, the definition of recessions, what happened, what's missing, and what is currently preventing us from having a recession right now. Now, obviously, none of these things are permanent. At some point between now and the end of time, there is going to be a recession in the United States. I do not know when. I'm not going to sit here and tell you the date and the time nor the hour because I don't know, okay? But right now, today, there is not one. I don't know. I'm not in the recession predicting business. Number one, I don't want one. You shouldn't want one either, okay? But it felt like for a time, probably 2022, 2023, it just felt extremely popular for people to want a recession and to be ready to predict one. That was the trend back then. And here was some of the reasons as to why. Remember, inflation at one point in that era was around 9%. It was bad. Okay, inflation was really bad. And I'm not gonna get into the causes of inflation because we've done that. We all know that inflation has come down, though it's still not fun for anybody. But inflation is not the cause of a recession. That's not the definition of a recession. It's not good, but that's an inflation, a recession, inflation is not, right? It's just not, that's not how those things work, okay? The definition, the textbook definition, as I've said this many times before, is 2 consecutive quarters of GDP. However, the way it's defined by the National Bureau of Economic Research, these are the official people who say this is a recession. There are other factors they look at outside of that. They look at unemployment, they look at jobs, they look at the stability of the economy and say, look, are people still working? Are people still buying stuff? Do we have GDP going up or down over those 2 quarters, yes or no? And then they determine whether or not all those things are happening. Now, we did at one point have those 2 consecutive quarters of negative GDP growth. For those that don't know what GDP is, that's gross domestic product. That's the value of the stuff that we produce. For example, you produce a phone. You sit down, you create a phone. That phone is $500. That $500 added up to all the other stuff we manufacture, and that counts into our GDP. So you didn't produce that phone, our GDP goes down. So you get 2 quarters of you not producing that one phone, then GDP does go down across the board. That tells us we're not being as productive. I can go into a whole rant as to why that's not the best way to measure the economy, but whatever. Okay, so we did have that at one point in time. I said that, technically on paper, that is a recession, but until they declare it, it ain't one. Okay, because again, if people are still buying stuff, which makes up 2/3 of the economy, and people are still getting hired, and people are still working, and unemployment is still low, then things are technically fine on paper, other than the fact that stuff is just not at a price that I like. I don't have to like it for there not to be a recession. So that's just kind of how it is. So we had inflation. Don't forget that we also had banks collapse due to higher interest rates. That did happen at one point in time. We did a ton of videos about all of those things happening. The market was down in 2022. Stocks like Nvidia, nobody, and I mean nobody, wanted to talk about those stocks back then, even though I was buying at that point in time for companies like Nvidia. NFTs, you remember them? NFTs, non-fungible tokens, those little ape coins and stuff that people really thought were going to be a thing. I ain't forgot. They weren't things anymore at this point in time. And then also, Bitcoin, a lot of those cryptocurrencies weren't doing so hot. FTX started to collapse. it looked very bad. But again, just because a bank collapses, just because inflation is high, that doesn't mean, that's not the definition of a recession. Now I'm looking out the window, so ooh, banks collapsing, I'm paying double or triple the price of eggs. My pocket don't feel great, but right, that's not the definition. When I look at the textbook and say, hey, my pockets don't feel good, I don't have as much money as I used to, that's not the definition of what a recession is. But the truth was, you were still spending money. As an economy, right? As an economy and as the public, we were all still spending money. Companies like Walmart, like Amazon, were still recording record profits because y'all were spending money. For example, holiday spending, both in, and we've done videos about this as well, at the end of 2022, at the end of 2023, they saw record profits because people were, whether it was COVID relief money that people had been saving, we had talked about record savings that people still had, people were still spending money. And that is truly what the economy comes down to at the end of the day. Are you still spending more money this year, more than next year, more than next year, so on and so forth? And that is primarily why we didn't run into a recession. So spending is the primary driver of that. And that is why the Fed lowered interest rates, because they want you to keep spending. If you are paying attention and if you have an online savings account, which means you have listened to me and we did a whole video around some of the highest paying savings accounts, after the Fed lowered interest rates, it's about a week, maybe 2 weeks ago, you've likely got an email like I did around, hey, we're changing our savings rates. This is expected. When they cut interest rates and they bring them down, what do you think happens to those savings rates? They also go down. Eventually, those rates are going to come down across the board. They used to be 4%, 4.5%. If they continue to cut rates, it's going to come down to 3%. It's going to come down to 2%, and that's going to incentivize you. The purpose here is to incentivize you to spend money, to continue to incentivize or stimulate the economy. Because what they want you to do, and that's the whole purpose of the Fed, is to stabilize the economy, is to do this. Well, if I can't sit my money and park it in the bank, then I am going to take my money out, take some money, don't take all your money out the bank. You also want to keep your emergency savings, right? But if I can't sit my money here and get paid 4% for doing nothing, I'm going to take some out and I'm going to put it into the stock market because Apple is going to invest it and hire more people. What does that do, right? Those people who get hired go buy stuff, right? Or I'm going to take it out and go buy an asset or go buy something or do something with the money that pushes it out into the economy versus keeping it still and doing nothing. That is why they are lowering interest rates, because now it's a, hey, you're not getting paid as much as you used to by sitting the money still or leaving it on ice getting paid. Maybe it's now time for me to take it out and go buy a house because interest rates on mortgages are now lower. Maybe it's a perfect time for me to go buy that car or start that business or whatever it is. That is the point. All about supply and demand. And that's why people are excited about lowering those interest rates. And it's why the market started to take off even more based on what the Fed was doing. That's this whole psychology of it. And it's why in reverse, when the Fed increased interest rates was to stop people from spending. It was to stop you from saying, hey, look, I know what's going on out here, but now that these savings accounts are paying 4 or 5%, let me take this money just hit it here, because if I can get 5% for doing nothing and taking very, very little risk, why would I do anything else? Right? Why risk it in a stock that might not do well and can crash? I can go get FDIC insurance for up to $250,000 and make 5% doing this. Nothing. Absolutely nothing, and getting 5% for doing that. That was the whole point, to take some of that money out of the market and sit it on the sideline. So they're moving in reverse. They're trying to get you to continue to stimulate the economy and push things forward to prevent what could be a recession in 2025. That is how we are getting here. Now, depending on what bank you want to listen to, what analyst you want to listen to, and I would argue the analysts' opinions aren't worth that much. These are the same analysts that told you it was going to be a 60-70% chance of recession in 2023 or in 2022, whatever year they decide to tell you. They're now saying it's a 20 to 25% chance in 2025. So it is what it is. And I told y'all the exact same thoughts back then. I think it was Goldman Sachs that said it was anywhere between 15 to 80%. Bro, if your range is that high, you don't know. It is okay to say that you don't know whether or not there's going to be a recession. I don't know. So I'm gonna just tell you flat out, I don't know. What I can tell you is the Fed is being relatively active in trying to navigate the situation. Is the Fed always perfect? No, they are not. Is the Fed responsible for all recessions and for the entire economy? Absolutely not, because Congress does play a big role in this as well. Congress is a mess. We know this. They do have a big part because they are the one who cuts the stimulus checks. That has a big part. They also debt ceilings and all that kind of stuff, the federal debt as a whole, all of that does come down to them. That has nothing to do with the Fed. But these are the levers that have to be pushed and played with to avoid a recession to begin with. But then you run into the jobs piece of it. And I think this is the one that I have my eye on, and it's the one that the Fed has their eye on too. Most experts and articles and textbooks are going to tell you that 5% is the bar of what low unemployment is. And I would generally agree with that. Right now, we are at about 4.2, 4.3% unemployment, which is contextually, like the last 3 years, that's kind of high. When the current administration took over, unemployment was about 6%. So we are creeping back up. We were like under 4%, which was like a 50-year low. So it is starting to creep back up. We'll see where that number moves. But keeping people employed and spending money, and obviously if you want a job, you should be able to keep a job and do what you want to do. That is what you would prefer to see. That is going to be the thing. You always want to keep unemployment as low as you can. Okay, that is going to be the key thing, and that is going to be the major thing that is going to impact the stock market and really raise recession bells. And it's also going to be the thing that is going to impact what the Fed does and does not do. Should I start to see unemployment start to creep even higher and hit or go above 5%, that's when your boy is going to start raising eyebrows. Am I going to get up here and start raising recession bells and start acting a fool? No, I'm not going to do that for several reasons. Number one, we here have been through enough recessions to know what stocks to buy, what to do, all that type of stuff. If you don't know, I've done a video covering all that kind of stuff. We know how to act, okay? Get ready so you ain't got to be ready, right? Or how does the phrase go? Be ready so you ain't got to get ready. Y'all know the point, okay? But we don't have to panic, and also 4.3 is not 5, and usually it takes a very long time to get there unless it's a pandemic. Right? Hopefully we don't hit that. But it's not something I would be overly concerned about. And just because the Fed raises or lowers rates does not guarantee that the stock market is going to go in any one direction. But the key thing is, it's hard to predict recessions. If you knew what was going to happen recession-wise, then you would have done that thing already, right? Or you would have known what that root cause was already. Same thing like if you knew you were going to have a car wreck that day, you would have walked. You didn't know, right? So it's kind of that type of scenario. So it's not anything I would be overly concerned about, but it's really going to be about unemployment. It's really going to be about, are we continuing to post jobs and create new jobs? And if these trends are going to continue or not. I think the Fed is on the right path here by lowering interest rates, especially around the holiday season, to get people to continue to spend money. And I think they might actually be right where they want to be and where they should be. I didn't think they were initially, but after sitting on it, I think they are in the right spots. But now, since the stock market is up almost 20%, it may continue on that path. And if that is the case, you are going to need to know where exactly to invest in a time like this, especially now that we are in the month of October. If you want to know what stocks make the most sense for a month like this, you want to check out this video right here.